Welcome back to the channel. Today we are going to be comparing $2 trillion plus companies, Amazon versus Alphabet. We will consider the past performance, revenue growth, profitability, risks, management, valuation, and finally I will answer the question, which company is a better buy today? What's going on, investors? Hopefully guys are doing well out there. Welcome back to another video. Starting from the performance and historical returns for these two companies, Amazon over the last 5 years delivered 65% returns for investors, which is actually not even market-beating returns. Meanwhile, Alphabet returned 140% over the last 5 years. So in terms of the performance, Alphabet have better returns for investors over the last 5 years. Let's talk about the business and how these two juggernauts generate their revenue. For the Amazon, most of the revenue is coming from online stores. Also, Amazon has physical stores, which is mostly for diversification purposes. Amazon has also third-party seller services with almost 25% revenue market share, and this is basically your fulfillment by Amazon, shipping fees, and also advertising, where sellers can increase the visibility for their products. Amazon also has advertising business which is growing rapidly, and I would say taking market share from two other competitors, Alphabet and also Meta. Advertising for Amazon is very simple because Amazon already knows what customer wants. Customer is searching for the particular keyword, and Amazon exactly knows his browsing history, his searching history, his order history, what products he added to the shopping cart. So Amazon knows everything about the customer, and this adds a highly targeted. In subscription, we have Amazon Prime, Prime Video, and other subscriptions, and AWS, which is the most profitable business segment for Amazon, is basically their cloud division. Alphabet's revenue is less diversified comparing to Amazon. More than 56% of Alphabet's revenue is coming from search. This is advertising in search. Also, Alphabet has YouTube ads with 10.4% and network with 8.7%. This business segment is actually declining for Alphabet already for a few years. Alphabet in addition has subscriptions with 11.6%, and here we have YouTube TV. Here we also have the YouTube Music and other subscriptions. In addition, Google devices like Pixel and also the pay cut from Google Play is also included in this business segment. In addition, Google has cloud with 12.4%. Talking about the revenue growth for these two companies, currently we have the data from 2005, and you can see basically they were making less than $10 billion in revenue in 2005, and fast forward to today, Amazon is generating $650 billion. Meanwhile, Google is generating almost $360 billion. Absolutely amazing growth over the last 20 years. Meanwhile, we see that Amazon delivered 25.3 CAGR over the last 20 years, and Google delivered 23.5% CAGR. From here, we can make a conclusion that the revenue of Amazon is growing faster. Profitability is what actually matters. Profitability will deliver return for investors, and we see that Google's profitability is significantly higher with Amazon. For Google, in average, the operating margin is north of 30%. Meanwhile, for Amazon, in average, around 5%. But in terms of the growth, Google's operating margin increased from 34% in 2005 to around 33% in 2025, which means it's actually flat. Meanwhile, for the Amazon, the operating margin increased from 5.6 to almost 11%. So in terms of the profitability, of course, Google is much more profitable company compared to Amazon. But in terms of the dynamics and how Amazon is improving the operating margins, I would say here Amazon did a better job comparing to Google. Return on investment for Google is also significantly higher than for Amazon, but here we can see similar picture. Google return on investment improved from 27% to 31%, which of course is very good job from the management of Google. But for Amazon, from 6% to 13.6%, so we here again more than doubled in terms of the return on invested capital. Very good job for Amazon here as well. Very good job for both of the companies, but we can see that Amazon more than doubled the return on invested capital over the last 10 years. Meanwhile, for Google, it's just a light increase. Let's talk about the management. CEO for Amazon is Andy Jassy. Andy Jassy was leading the cloud computing segment AWS for north of 10 years before becoming Amazon CEO after Jeff Bezos retired. Meanwhile, for Google, we have Sundar Pichai. I believe both leaders are outstanding leaders. For Andy Jassy, he was leading leading the most profitable business unit in Amazon for a long time, get trust from Jeff Bezos, and finally become CEO of Amazon. And currently he is taking care of all business segments of Amazon, including retail. One of my main bullish theses about the Amazon is that retail's margins will be improved significantly by introducing robotics and efficiency optimization. Andy Jassy is doing a good job there. And meanwhile, for AWS, he continued to take a lot of attention there. Amazon is having a lot of initiatives with investing in Anthropic, building their proprietary LLM models, improving user experience, and introducing a lot of AI experiences in Amazon.com and other services. Meanwhile, for Google, they have a lot of critics that they are lagging with AI, losing competition, nobody is using search anymore, and stuff like this. I believe that Sundar Pichai is actually doing a good job, and during the latest Google I/O they presented a lot of different innovations. I was just blown away from the amount of stuff they delivered over the last 1 year. I think both CEOs are incredible and very high quality, but I believe Andy Jassy are a bit more motivated and a bit more customer driven. So here I would prefer Amazon CEO over Google CEO. Let's continue with the risks. From the perspective of risks, for Amazon, I'm thinking if we are going to recession, the consumer will slow down their spending, which of course will slow down the revenue growth for Amazon. And also in terms of the AWS, as I mentioned, AWS is now top 1 by market share in cloud computing, but Microsoft Azure is growing faster than AWS. So Microsoft Azure is taking market share from AWS. And also Google is top 3 in market share, is also growing very rapidly. But in terms of the Alphabet, I see more risks here. Firstly, currently we have Department of Justice investigating Google overpaying $20 billion every single year to Apple to be a default search engine in Safari. So this could lead to actually a breakup of the company. And the worst case scenario for Google, I believe, is breakup of Google Chrome, because Google Chrome standalone application will not worth too much money. Google could not be generate significant amount of money, amount of cash from this sale. But I believe that this is significantly improving the ecosystem of Google. So breakup, especially of the Chrome, is actually devastating for Google. Another risk, there are many discussions and acts currently that nobody is using search, and most of the young people are actually using ChatGPT, Gemini, Grok, and other LLMs. Myself, I also use ChatGPT for significant amount of queries, but I believe that AI mode, which was introduced during Google I/O, will actually be a game changer, and Google will be able to protect their market share. But let's see how it goes. In terms of the recession, of course, Google is mostly advertising company. So if we're coming into the recession, Google's revenue will take a hit. And also Google Cloud competition. Google currently is trying to take market share. Margins for Google Cloud are still significantly lower comparing to AWS and Azure, but they are trying to grow and they are trying to take the market share from 2 top places. Coming to the price targets from analysts, currently for Amazon, we have price targets from $195 to north of almost $300 per share over the next 12 months. Meanwhile, for Google, we have from 160 to around 240, which brings us to approximately 20% upside for Amazon and 18% upside for Google. Myself, I don't pay too much attention to analyst price targets. I usually pay attention to revenues projection, free cash flow projection, profitability projection, and stuff like this, margins. But for price targets, I usually kind of ignore this because analysts usually are wrong and they are adjusting price targets following the price. Coming to the valuation of Amazon and Google, for the valuation purposes, I will use a forward price to operating cash flow. You would ask why not price to earnings ratio? Because both of these companies currently investing significantly in their cloud computing division, which leads to increasement in the capital expenditures and decrease in net income. So I believe that price to operating cash flow for these two companies are much more fair to use. For Amazon, we can see that medium is 19 for forward price to operating cash flow. Currently, we are trading at 15. So Amazon is underpriced. And for Google, we see a similar picture with median of 15, and currently we are trading at 13. So here, approximately both companies are underpriced in terms of valuation, in terms of price to operating cash flow. But I would prefer to use a multiple method to value the company and estimate the potential returns in the future. So for Google, I'm estimating 10% here revenue growth over the next 5 years. And in terms of the net income margins, I project 30% net income margins in the end of 2029. Price to earnings of 22, which is 5 years average, dividend of 0.41% and buybacks of 2.5%, which brings us to upside potential of 126% over the next 5 years. If you want to double your money with Google stock, you need to buy Google at $191 per share. Meanwhile, currently Google is trading at just $169 per share. My projection for the Google stock in 2029 is $381 per share. And let's see what is the situation with Amazon. For the Amazon, we have the projection of revenue growth from 10% to around 9% in 2029. Operating free cash flow margin, I project the increase from 18% to 22%. As I mentioned, robotics and cost cutting will improve operating margins for Amazon significantly. So I project the increase here to 22%. And price to operating cash flow, I set as 22. And I do not project Amazon to pay dividends nor do buybacks. For Amazon, I see upside potential of 87% over the next 5 years. And if you want to double your money with Amazon, you need to buy at $188 per share. I see Amazon over the next 5 years to see the price per share of $377 per share. In terms of the technicals and price chart, currently we see that Amazon peaked in 2021, 2022, then that share price dropped, and currently we have a rebound to all-time highs. And currently we are retesting this 10 years, actually 20 years trend. So this retest was very beautiful. And here you can see we have volume shelf profile. So currently the price jumped out of this level. So I believe this was a significantly good buy for Amazon, and I was adding a lot of shares in April market crash. In terms of the Google, we have similar picture. We have 10 years uptrend, and currently Google tested the bottom of this trend. In addition, we have all-time high here, which played as a support for the price, and currently Google is bouncing. Which company I believe is a better buy at current prices? Actually, in my public YouTube investing portfolio, I have both of these companies. You can see I have Amazon, and this is taking 18% of the portfolio. Also, I have Google is taking 12% for my investing portfolio. Currently, this is top 2 positions. So I am actually significantly bullish on both of these companies. But I believe that Amazon will provide a better risk-reward opportunities, even though we projected that Google will deliver better results over the next 5 years. But because Google has more risks, especially I'm worried about the breakup of the Chrome, force Google to sell out the Chrome and make it standalone application. I believe this will be devastating for the company. In addition, there are a lot of uncertainties for the Google search. Meanwhile, for Amazon, we do not have such amount of uncertainties. So I believe that Amazon is actually de-risked here. Meanwhile, Google has a lot of uncertainties. So I put my money where my mouth is. You can see that Amazon is taking 18% of the portfolio. Meanwhile, Google is taking 12% of the portfolio. I believe that Amazon is a better buy today. Let me know in the comments what do you think, which company is the better buy today, and also drop in the comments which 2 companies you want me to compare next. I hope you guys enjoyed this video. If you did, make sure to smash the like button, and if you really enjoyed the content, consider subscribing to the channel. Thank you so much, my friend, for stopping by. I will see you in the next one.